ESG stands for environmental, social, and governance. These pillars are no longer just marketing terms, but crucial, measurable risk factors influencing a company's long-term viability. There's a growing institutional demand for integrating ESG across all asset classes. It's now a core part of due diligence, not just an optional add-on. Let's break down each component, environmental, social, and governance, and understand their shift towards material risks. Environmental aspects cover a company's impact on nature, including emissions, energy use, waste, and climate impact. These are direct, measurable risks. Social factors involve a company's relationship with its employees, suppliers, customers, and communities. Think labor standards, diversity, equity, inclusion, and data privacy. Governance pertains to a company's leadership, executive pay, audits, internal controls, and shareholder rights. It's about how a company is run. The focus has firmly shifted from values-based investing to financially relevant material risks directly tied to operational performance and profitability. Now let's zoom in on governance, often considered the unsung hero of ESG. Governance is increasingly seen as the strongest predictor of long-term returns. Poor governance is a red flag, often linked to fraud, compliance failures, and severe reputational damage. Investors are prioritizing robust board independence, fair executive pay alignment, and stringent audit quality, understanding that solid governance frameworks can impact a company's cost of capital. Next, we tackle the elephant in the room, greenwashing, a pervasive challenge in the ESG space. Greenwashing erodes investor trust and misallocates capital. It's where companies exaggerate their climate targets or make dubious sustainability claims. Investors are demanding more verification and auditability. The pressure to appear green has unfortunately led to a rise in ESG washing within funds themselves. Let's define greenwashing and expose some common tactics used by companies. Tactics include vague claims like eco-friendly without metrics, selective disclosure of positive data while hiding negative, and misleading carbon offsets that lack verification. The ESG market currently grapples with data chaos, leading to conflicting scores and widespread confusion. This chaos stems from inconsistent methodologies across providers, like MSCI versus Sustainalytics. Companies can be rated high on one scale and low on another, making comparisons difficult. A lack of standardized reporting creates noise over signal, making it incredibly difficult for investors to accurately compare companies across different geographies and sectors. However, a new regulatory landscape is emerging, particularly from the EU, aiming to bring clarity and accountability. These regulations are driving global ESG accountability, ushering in more mandatory disclosures and heightened scrutiny from all stakeholders. Let's explore the Corporate Sustainability Reporting Directive, or CSRD, and its pivotal concept of double materiality. The CSRD is a game changer, impacting over 50,000 companies globally, not just within the EU. Its cornerstone is double materiality, requiring companies to report on how sustainability issues affect their performance and how their operations impact society and the environment. This means granular reporting across climate, human rights, and governance factors, demanding unprecedented transparency. Alongside CSRD, we have the EU taxonomy regulation, designed to standardize what truly counts as a sustainable economic activity. The taxonomy provides a crucial rulebook for what genuinely qualifies as green, helping investors verify real sustainability alignment and avoid greenwashing. It applies to both companies and financial products. The stakes are rising, with significant litigation risks and enforcement actions for greenwashing claims. We're seeing a surge in lawsuits against exaggerated sustainability claims, regulators imposing hefty fines for misleading disclosures, and funds facing rigorous audits to justify their ESG labels. Fortunately, technology, particularly AI, offers powerful solutions to navigate this complex ESG landscape. AI is now central to making sense of vast amounts of ESG data and bringing clarity to complex information. Machine learning models are adept at detecting anomalies and inconsistencies within ESG data, helping to unmask potential greenwashing. AI accelerates reporting, streamlines disclosure mapping, and quickly flags potential risks, allowing for faster and more informed decision-making. Let's look at how AI revolutionizes data collection, aggregation, and predictive risk modeling for ESG. I can pull unstructured data from countless sources, filings, news, supply chains, and provide predictive alerts on controversies, violations, and governance red flags. It also automates scoring frameworks aligned with new regulations. To truly leverage these technologies, firms must invest in robust ESG data infrastructure. ESG reporting is moving towards audit-grade expectations, requiring firms to invest in integrated data platforms across all departments to ensure consistency and accuracy. This means APIs connecting ESG data to financial modeling and risk systems, establishing a, quote, single source of truth to avoid inconsistent reporting and enhance data integrity. Investing in assurance-ready and interoperable systems is critical for future compliance and strategic planning. These systems ensure data can be verified by external auditors, enabling compliance with multiple frameworks like CSRD, ISSB, and GRI, and supporting sophisticated scenario analysis for climate transition plans. As the market matures, new strategic trends are taking shape, indicating the future direction of ESG investing. Transition financing is gaining momentum as companies actively shift to lower carbon models, while nature-based solutions and biodiversity are becoming core themes in investment strategies. Let's explore transition investing and new asset classes like natural capital that are entering the mainstream. Capital is increasingly flowing into renewable infrastructure, hydrogen, and EV supply chains. We're also seeing a focus on natural capital, investments in forests, wetlands, and regenerative agriculture, often through blended finance structures. Finally, global standards are emerging, aiming to create a more cohesive and comparable ESG landscape. The alignment with ISSB and new EU rules for ESG rating providers signals a new era of transparency. The ISSB is fast becoming the global baseline for climate-related reporting. Meanwhile, the EU is adding oversight and transparency requirements for rating agencies, demanding methodology disclosure, conflict of interest checks, and regular audits. In conclusion, ESG investing is undergoing a profound transformation. Let's recap the challenges and opportunities. ESG is evolving from a narrative-driven approach to a highly regulated, data-driven discipline. While greenwashing risks are rising, so are the advanced tools available to combat it effectively. This presents a long-term opportunity for investors and firms that adapt early to this new reality. Remember, this content is for educational purposes only and not financial advice. Thank you for watching.